Hi, this is Kirk Davis at Green River Community College. I want to show you this awesome tool for helping you do financial projections for your business. We call this a 504 spreadsheet because it was built for the 504 SBA loan program. And what this does is it does a 3-year forecast for your financial statements. And I'm going to show you, this is a blank one. I'm going to show you what to do here and then show you a live example. This first tab, so you're going to see these tabs along the bottom. And so these are the tabs we work in. This first one's called a 504. It's essentially where we enter the starting balance sheet, or if you're starting a business, it's where we enter the startup expenses. So you'll see that there's categories here for land, building, construction. Let me show you a blank one here. This blank one, as you're adding information into these categories, some of these fees will come up, and you can just zero those out if they're not relevant to you, if you're not really doing a 504 loan. And to show you the example, this is a bike store that I just did recently, and right at this point, when you're first starting a business, you tend to guesstimate these costs. So these are guesstimated costs. If you're an existing business, you actually take whatever balance sheet you want to start with and enter it into these categories. And what we're doing is we're summarizing. We're doing the main summary categories. So we're doing equipment and machinery, and you're seeing that it's not a full list. But there's another tab down here called CASS, which is critical assumptions, and you can actually list them out in detail here and then summarize them for the 504 sheet. And when you get done here, you're going to come up with a total. Like these guys came up with a total of 130,000, and then we actually put in how much of that is going to be a loan. So we've got the bank will do 45,000, and then they'll do 85,000 out of their own pocket. So when you put these numbers in, if you go over here to this loan tab, then it'll actually automatically put these in. You'll need to enter the interest rate. We were guessing on these. Um, the way the owner set it up in this particular scenario is he's putting in his portion not as equity but as debt, and he's going to pay himself back at 10% interest. We think the bank's loan will be somewhere around 7%. We're looking at a 5-year payback period, and it'll automatically calculate into the spreadsheet. That's what's great about this spreadsheet. So once you enter all the information in, you can set out how much is loan, how much is equity, and that will transfer over to this use sheet. Bankers love this when you show it to them. It's a sources and uses of funds. So it'll show how much is cash and how much you're borrowing, but it'll come up with a total source of funds, and then it'll actually categorize it into which category that money will be used for, and you'll see that these two things should be the same. So that will create balance on our balance sheet. So all of this information, this Inc. 1 is income statement year 1, cash flow year 1, and balance sheet year 1. And so what this does is it automatically creates the balance sheet. Most small businesses don't do balance sheets, but that's a big mistake for financial analysis purposes, but also for banking purposes. You need to really keep track of your balance sheet. So once we've done this tab, you can make certain that this lines up, and then that will automatically create your balance sheet. The next easy thing here is the income statement. I always like to start with the expenses, and you can go in and change these categories here. The ones not to change would be this interest, depreciation, amortization, because those are calculated things based on what you've already put in. And but you can change these to match your typical business monthly expenses. And these are examples in the filled out sheet. In the blank sheet, it looks like this. It's just blank. You can put in your percentages for payroll taxes, for workers' comp, or if you have bad debt. Some people will put B&O taxes, depending on what other categories there are. These are very flexible, and the idea is you can change this to the actual year and date you're working in, and it'll change them all the way across. One of the problems this has is I actually have to change the date up here to something like the 7th, and then it fixes it. So now I've got January, February, March, April, May, June, July. I know I'm moving kind of fast through this, hopefully not to be too boring. But once you enter in the expenses, it'll look like this, and you should get a total expenses line. So this, initially 8,000, 9,000, spending up to 15,000 a month. And then at the bottom of the sheet, we want to put in profit centers. So I want to show you here on the blank sheet. You have an opportunity here because of some hidden cells. You'll see how I'm going to right click and unhide cells. I've got up to 8 different profit centers I can do here. And if you're good on Excel, you can actually create more, but you have at least 8 standard ones. And a lot of times what we do is we just we format or summarize several categories so that we can keep it within either 4 or 8 profit centers. But what you're doing here is you're laying out the profit centers of your business, and this is your projected revenue for the year. This would be your projected expenses, cost of goods sold on those revenues. So to go back to our bike example, he has several categories, and in his sheet, actually, he's got it broken down on his own projections in detail. But we just took the summary numbers to make it simple, and we put in the month-by-month sales projections with the cost of goods sold down here of 54.7%, and that just calculated automatically. So once you have this in, what you'll see is that you've got a balance sheet already, you've got an income statement, and from those two things, it automatically calculates a cash flow statement. So this will tell you how much money at the bottom of the page is actually in your bank account. This has been very accurate when I've worked with other businesses. I've actually seen businesses that we've projected a cash flow loss, and it's held 100% true. So one of the things you'll notice here, you have an opportunity on your cash flow sheet to put in some other categories that could be relevant to you. In this owner's particular case, his accountant advised him to do an owner withdrawal. So he actually has put in an owner's withdrawal. So even though his net profit might be $81,000, his net cash flow is going to be like $45,000. And that's very powerful, and that's very precise. Now I want to show you how to do year 2 so we don't miss that. So that builds your year 1. It's taking me a half an hour to 45 minutes when somebody has their numbers in. This goes in very fast, and it goes in very easy. And I do this with both startups, and I do it with existing businesses on this sheet. This over here, Inc. 2, is the income statement for year 2. And I just want to show you how easy this is. For projection purposes, to keep it simple, and we say we may increase our sales by 10%, and you enter it into the revenue growth, it automatically calculates that. Then we do expense growth. We say expenses will grow by 4%, and it automatically adds a 4% growth to the expenses. And this is simple. This is the simple way to do it. The right way to do it would be go in and enter in the real numbers, because you could do it the hard way. But a lot of times for banking purposes, this works just fine because it's kind of a guess going forward. And then the only other thing you have to do down here in the cost of goods sold is 57.4, if I remember the cost of goods sold right. And you just put in that percentage, and it automatically puts that in. The same thing is true. Now you have a balance sheet for year 2 and a cash flow statement for year 2, and then you do the same thing for year 3. Go in here to year 3. Do whatever revenue growth you project, whatever expense growth you project, and put in our 57.4. And now we have 3 full years of financial statements just that quick. There are some other things along here that are very helpful. This is a break-even calculator, and it shows you what happens if you go below or above the break-even calculation. This is an accounts payable. So if you have terms with your vendors, and you have 30-day terms, and half of your inventory is on 30-day terms, you can just list that 50% and change that to 50%, and then that will show a little more accurate on your cash flow statements. I'm just going to return that. Then you also have here an accounts receivable. So if by chance you're one of those companies who has an accounts receivable, you can say, I get this much of my money in 30 days, 60 days, 90 days, and again, it creates a very accurate cash flow. There's a depreciation schedule if you want to manipulate that a little bit more. If you're going to the bank for a loan, something that can be very helpful is something called a debt coverage ratio. And so this tab here will actually show you the debt coverage ratio. And if we're going to the bank for an additional loan, we can actually go to the loan tab, and you've got 2 more loan categories you can add information on here. So if we were going to go to the bank for an additional $50,000, we could enter that there, and it becomes a kind of a what-if scenario. So let's see, the debt coverage ratio. Typically, the banks are looking for about a 1.2 debt coverage ratio. And so if you see that your number is above 1.2, you're doing very good. Let's see, that covers most of it. I know you'll have questions because I went through this quickly. I'm including this link along with the sheet so that you can get right to it. If you have any questions, contact us at Green River Community College, where a good way to reach us is our phone number 253-520-6260. Or you could reach me at kdavis, that's the letter K and then Davis at greenriver.edu. Thanks for watching.